every new investor, I mean, every single person just getting started asks the exact same question. It's the one that can, totally paralyze you. Or if you get it wrong, it can lead to years of regret. When is the absolute perfect time to buy? We're all searching for that mythical market bottom.
It's a total obsession, isn't it? It's driven by this promise of, maximizing your profits, but it runs completely counter to what almost every piece of financial history tells us. As Warren Buffett famously put it, the best moment to invest was yesterday. The second best is today. And our deep dive today, well, it really confirms that powerful truth.
Right. Our sources, everything from behavioral studies to hard asset management data, they consistently prove that the actual time spent in the market just fundamentally beats any attempt to find that perfect entry point.
That's it, exactly. Our sources sort of pull back the curtain on why our human emotions, fear, greed, euphoria, why they sabotage us when we try to be clever.
Yeah.
And they show how simple, automated strategies, the ones built on regularity and discipline, just provide better results than these complex predictions.
So our mission today is pretty clear then. We want to give you the knowledge and the systems that are just plain superior to intuition and impulse when it comes to building wealth. We're looking for a fundamental shift in perspective for you, the learner. From desperately finding a specific date to simply adopting a disciplined long-term attitude. Okay, let's unpack this. The idea of buying low and selling high, it's so seductive, it's almost instinctual, right? It's the investor's dream. But the brutal reality is that relying on prediction is, well, it's incredibly risky because nobody succeeds at it consistently. I mean, nobody. Not even seasoned professionals with these huge research teams. The market is just too complex.
And that failure to predict, that's what opens the door for human nature to rush in. There is this massive, costly gap between what people think they can do, sell at the peak, buy at the absolute bottom, and what they actually do. The gap is driven entirely by our behavioral biases. I mean, John Bogle saw this decades ago. The average investor always underperforms the market precisely because they make decisions based on emotion.
It's that psychological cycle of the market that we all recognize, even if we sort of pretend we're immune to it.
We are definitely not immune.
I think so.
Exactly. Think about that feeling of euphoria. The market's high. Stocks have been rising for months. Everyone you know is talking about their latest stock picks. What happens? FOMO, fear of missing out. It drives people to jump in when the price is already way up there, often right before a peak. They feel safe because everything looks strong.
And then the exact opposite happens on the way down.
Precisely. When the market drops, say 20 or 30%, and panic is all over the news, fear and this deep-seated loss aversion just take over. Instead of seeing a sale, people see a bottomless pit. And that feeling compels them to sell at the absolute lowest point, which makes that paper loss permanent and very, very painful. So emotional investors do the exact opposite of their goal. They buy high and they sell low.
That emotional cycle makes perfect sense. But how expensive is it, really? Do the sources give us concrete numbers on how much this bad timing actually costs investors?
They absolutely do. And the numbers are, they're pretty startling. We have two key pieces of data here that really make the case against timing irrefutable. First, a finding from JP Morgan Asset Management. They calculated what happens if an investor missed just the 10 best performing days of the S&P 500 over a 20-year period.
Just 10 days out of what, like 5,000 trading days? That seems so small.
It sounds minimal, but the consequence is severe. If you missed those 10 days, your overall return over 2 decades would have been halved. Just think about that. And those 10 days, they usually don't happen when everything is calm. They happen right after a massive drop when panic is still high and you're on the sidelines trying to wait and see. Missing that brief, powerful rebound just because you wanted certainty completely wipes out years of good performance. It just goes to show the greatest risk isn't staying invested, it's being on the sidelines.
And if that isn't enough, there's the Delbar study. That's sort of the definitive look at this, isn't it? For our listeners who might not be familiar, can you explain what makes Delbar's work so important here?
Yeah, of course. Delbar publishes this annual study, the quantitative analysis of investor behavior. And their 20-year study is really the gold standard for comparing how individual investors in mutual funds actually do compared to a broad market index like the S&P 500. It's not theory, it's real-world results.
So what did that long-term, real-world study find?
It revealed just systematic underperformance. While the S&P 500 index averaged, around 9 to 10% annually over that time, the average individual investor only got about 4 to 5%. That massive gap, we're talking about half the potential return, is almost entirely because of emotional timing. They're buying in euphoria, selling in panic. The biases are just so clear. Loss aversion, herd mentality, and overconfidence. This belief that they can somehow see the reversals coming.
Wow. Okay. The data provides a very sobering conclusion then. Trying to predict the future is a fool's errand, and a really expensive one at that. The time you spend in the market is just exponentially more important than the moment you enter.
And since timing is demonstrably impossible and emotionally destructive, the solution is elegantly simple. You remove the emotion entirely. You replace it with discipline, which brings us directly to our primary defensive strategy, dollar cost averaging, or DCA.
DCA, or programmed investing. It's purely mechanical, right? You invest the same fixed amount, say $100, $200, whatever, every single month. It doesn't matter if the market is up, down, or sideways. No thinking, no panic. It's just automatic.
And the advantages are twofold. They are emotional and they are mechanical.
Yeah.
First, the emotional serenity you get is just immense. You reduce all that stress linked to the daily noise of the market. The decision's already been made.
And mechanically, that's where the real genius is. It actually protects you mathematically from buying only at the top, doesn't it?
It forces you into rational behavior. By investing a fixed amount, you are mechanically buying more shares when prices are low and fewer shares when prices are high. This just smooths out your average purchase price over time. Let's make it concrete. Let's say you invest $100 a month. If the stock is $10, you get 10 shares. But if the price drops to $5 next month, your same $100 now buys you 20 shares. It forces you to take advantage of dips.
Which is exactly what the emotional investor feels to do. Plus, by staying invested, you let compound interest do its thing over the long term. That famous snowball effect needs time, and DCA ensures you're always feeding the snowball. It's disciplined, automated, and prevents those big emotional mistakes.
Yeah, I love the analogy that DC is like going to the gym for your investment. It's regular, it can be a bit boring, but it's incredibly reliable in the long run. Every month, you're just laying another brick, and eventually you've built a fortress.
That seems like a solid, essential plan. But here's where it gets really interesting. What about the lump sum investor? What if you get a big bonus or an inheritance, and you can invest a large amount all at once? Doesn't the math say that getting all that money working immediately is better?
Purely statistically, yes. The math is on the side of the lump sum approach. If you have a large sum today, investing it all immediately is generally more profitable. History just shows us the market goes up more often than it goes down. So getting your money exposed to those gains sooner is, statistically speaking, the superior move.
And do the sources have specific numbers on that? I mean, how much of an advantage are we talking about?
They do. There's a definitive Vanguard study that looked at this. It compared lump sum versus DCA across thousands of historical scenarios, and the conclusion was pretty striking. Lump sum outperformed DCA at about 70% of those scenarios.
Wow, 70%. That's a really strong majority.
It is. They calculated an average advantage of about 2.2% over a single year for a 100% stock portfolio. So yeah, statistically, lump sum wins the race. It maximizes your time in the market.
Okay, that's compelling. But it forces us to look beyond the spreadsheet, doesn't it? We don't live in the average world. What about the person who puts a huge chunk of their capital in and then watches it immediately drop 20, 30, even 40%? What about that psychological pain?
And that is the core conflict. Statistics are cold averages, but your experience is intensely personal. If you happen to invest that lump sum right before a major crash, the psychological shock can be, well, unbearable.
And that stress often pushes you to make the mistake we already talked about, selling in a panic and locking in a massive loss.
Precisely. And the source material is very clear on this. While lump sum is statistically better, it carries a huge emotional risk. So the takeaway isn't that one is always better. It depends entirely on the investor's own profile. If you know you can't stomach a sudden deep drop, then breaking it up with DCA is the psychologically safer strategy. The best strategy is always the one you can actually stick with without panicking.
Okay, now, for those more rigorous investors who like the discipline but still want to optimize their enterprises, the sources talk about something called smart DCA. This sounds like adding a layer of data back into the system. How does that work in simple terms?
The goal is to move from a blind, fixed investment to more of a conditional, contrarian logic. Instead of just investing the same amount no matter what, you use a technical measure to get an objective idea of whether an asset is cheap or expensive right now.
So you're looking for an objective baseline for what normal is.
Exactly. The method they use is a linear regression line based on 300 weekly periods, so about 6 years of data. Think of it like drawing the fair value channel for that investment. It gives you an objective baseline so you aren't just guessing what cheap means.
And once you have that baseline, what's the rule?
The rule is pretty simple. If the current price is below that long-term trend line, meaning it's statistically cheap, you increase your DCA amount. If the price is way above the trend line, suggesting the market's euphoric, you invest less. They even suggest a factor 3 rule. So if the price is 10% below the trend, you could increase your DCA by 30%.
So the objective data forces you to act against your own emotional bias. You invest more when others are scared and less when they're greedy.
And studies on this, sometimes called enhanced DCA, they validate it. They show this conditional logic outperforms classic DCA in 90% of cases, adding an extra 30 to 70 basis points of return per year on average.
And for our listeners, 30 to 70 basis points is an extra 0.3% to 0.7% a year. That really adds up over time.
It really does. But the sources do add a big caveat. This is not a passive system. It requires consistent monitoring and a cash reserve to fund those bigger purchases when the market is low. It adds complexity back into the picture.
So it's more like assisted piloting, not cruise control. It takes effort.
Okay, so let's bring this back to managing a whole portfolio. Say you have a target allocation, maybe 70% stocks, 30% bonds, and then stocks take off and your portfolio drifts to 80-20. Do you sell to rebalance?
This is a crucial point. And for the disciplined investor, the simple answer is no. You generally don't sell to rebalance. Selling, or even just shifting money around inside your portfolio, can trigger fees, and more importantly, it can trigger taxes on your capital gains.
Wait, I get the part about avoiding fees and taxes. But isn't there a risk that by only putting new money into the losers, you're missing out on the winners continuing to run? Don't you have to sell high sometimes to lock in a gain?
That's the emotional temptation, right? But the discipline method avoids those psychological traps. The recommended approach is to rebalance using your new contributions. You just direct your regular DCA money only toward the assets that are now underweighted, the ones that have dropped or lagged, until your original targets are met again. So if I'm 80-20 instead of 70-30, I put all my new monthly money into that 20% bond bucket until it naturally creeps back up to 30%.
Exactly. This strategy automatically forces you to buy low because you're buying what hasn't performed as well, but you do it without incurring the costs or emotional risk of selling what has already gone up. Discipline over emotion means you rebalance smoothly, without disruption, using your greatest asset time.
We've covered a lot in this deep dive. We saw why market timing is a psychological and financial trap backed by that shocking data from Dalbar and JP Morgan. We contrasted the emotional comfort of DCA with the statistical edge of lump sum investing. And finally, we learned how to rebalance a portfolio just by directing new money, not by selling.
It does raise a bigger question, though, one that goes beyond just finance. We established that individual investors suffer from herd mentality, loss aversion, and overconfidence. These things lead them to abandon rational plans under pressure. So if disciplined, automated methods like DCA and on-selling rebalancing are proven to reduce those emotional errors in investing, what other areas of your life, fitness, your career, learning a new skill, what could benefit from replacing that impulsive, reactive decision-making with automated, disciplined regularity?
It really always comes down to consistency over intensity, doesn't it? Thank you for guiding us through this source material.
It was a pleasure. Continue your research and always make sure that your own approach aligns with your financial goals and, just as importantly, your true risk tolerance.